Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Seth Wunder, Chief Investment Officer at Acorns, to discuss why diversification in one's portfolio will help to limit the risk. Seth, it's great to see you as always. Welcome back to Trade Talks. And before we get into diversification, I want to get your thoughts on the macro here. Do you think the Fed's current strategy is credibility lacking at this point?
Yeah, well, thanks for having me back. I wouldn't say that they're fully credibility lacking, but I do think that they are close. So right now you've got Fed funds rate that's dramatically above where inflation is. I mean, last month inflation came in at only 4% relative to trend, so it's now down 11 months in a row. If you look at it ex shelter, which is important because there's some funky math with how shelter is quantified, it was actually less than 2%. And they're talking about having just taken a pause, start thinking about raising rates again starting in July. So I think they're close. We'll see if they actually do raise in July and then in subsequent meetings after that. But you would have to make the argument that they're close to going overboard. So we'll see.
Well, it's interesting because despite the macro issues that are out there, and of course, Fed policy, I mean, we're talking about 52-week highs last week, right? So do you think the market is climbing a wall of worry?
Well, yeah, I mean, that's the beauty of it. You know, so many people get caught up in the economic cycle and the news sound bites and so forth. But the market has historically been a discounting mechanism. That's the way that people should be thinking about investing, is what's going to happen tomorrow and in the future. The market had a terrible year last year when the Fed was behind the curve and not raising rates fast enough and was anticipating that. And to your point, now we're probably close to 3 quarters in a row with well over 5% market returns. And so the market really is seeing through it, which was the debate for a while now on a soft landing, and the economy seems to be holding in. So, you know, the idea of trying to invest looking at the current market, current economy, or even worse in a rearview mirror is a fool's errand. And I think the market is teaching people that thinking about long-term investing is the right way to think about how to make money in the market on a sustained basis.
Right. And my next question to you, because you and I talk about diversification all the time, over the past 3 quarters, to your point, the moves that we've seen have really been predicated on a handful, let's call it 7 to 11 stocks, right? So why should investors continue to focus on diversifying?
Well, it's actually interesting. So certainly if you look at the S&P 500 or even, let's say, a more narrow index like the Dow, there have been a very small handful of stocks, as you noted, that have really powered the market. But if you look at an equally weighted distribution of the broader stock market over thousands of stocks, that measure is actually close to all-time highs. There's actually more breadth when you really branch out and look at the market holistically than when you look at some of the more popular indices, as people tend to do. And in the last, let's say, 2 months, you've started to see more highs coming in other sectors outside of energy. But even in the last couple of weeks, financials have started to do better. You know, the reality is that breadth will continue to improve as the market does better. At least that's in my opinion, the way you look at it. And as you look at tea leaves on a week-to-week and month-to-month basis, you know, we're starting to see that. Diversification is important because the reality is over any shorter period of time, anything can lead the market, and that's a very difficult thing to predict. But what you want to do is, it goes back to that proverbial saying, and don't put too many eggs in one basket. You know, if you try to concentrate yourself in any one particular investment, you just have a lot of risk, or even in a few. And history has shown that diversification allows you to have multiple opportunities to have wins and generate good long-term returns without taking undue risk that one investment would really ruin your overall portfolio. So yeah, certainly this year, there's been a few that have really had outsized returns, but that's not a sustainable way for the market to generate long-term performance, and not the way that I think people should construct their portfolios.
And Seth, you had mentioned in your notes that we're in somewhat of a boring market. Why is boring good for the market?
Well, I mean, that's actually what's been fascinating, is that if you look at the volatility this year, it's down dramatically. I mean, last year, and we had a VIX that was averaging in the mid-20s. Now we're in the low teens. So volatility on a day-to-day basis has been cut by half if you measure it that way. But the number of 1% plus mover days is down, you know, something like 20x or some crazy stat like that. When we're not chasing volatility and the news cycle starts to slow, you get these more sustained market up moves, and history has shown that lower volatility markets have been an easier psychological market for people to invest in, and you've had more sustained returns for people to get comfortable with. And the reality is if you're investing for the long term, if you want to think about like running a marathon, people don't run marathons like they're sprints. They want to run it in a boring, consistent manner. And I think investing is very similar to that. And it allows for people to, let's say, dollar cost average and continue to invest on a consistent basis without having to necessarily have that worry that next day, next week, next month will have some huge surprise. That's not to say we want to have market downturns. We know that when there are market downturns, being able to buy the market on sale is a winning long-term strategy. But we've had multiple years since the beginning of COVID of elevated levels of volatility. And it would be nice to get back into a more secular, longer period of time of lower volatility, which we've had for consistent periods of time in the past 20, 30 years for sure. And we might be heading towards that right now.
All right, Seth, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.